Hello, my name is Stephanie Madden, and I'm one of the CEOs of Best Fit Footwear, along with Anna Trumbley and Ashlyn Brown, who you will be hearing from later in this presentation. The following sections will be covered in this presentation. I will be covering Best Fit Footwear's financial overview, years 2010 to 2020. Our annual total revenues. In 2011, we had $235 million in revenue. We grew that to $641 million in revenue by year 2020. We did have a dip in revenue one year from 2010 to 2011, small dip, but from 2011 on, we did experience growth in revenues thereafter. We actually doubled our revenue in 2020 from 2012. Annual earnings per share. This is our net profits divided by our shares of stock outstanding. In 2011 and 2012, we did not meet our investors' expectations, although as you can see, we were very close in 2012. The reasons is we had reduced net profits from increased operating expenses from opening up our Latin America plant. We had increased expenses from increasing our SQ rating in our plants, as well as issuing shares of stock to help finance our Latin America plant. In 2013, as you can see, our earnings per share grew above investor expectations and continued to do so thereon. In 2015, as net profit grew, we started repurchasing back our stock, and we were able to see a significant increase in our earnings per share over investor expectations from doing so. Return on equity. This is net profit divided by our average beginning and ending year stockholder equity. In 2011, we did see a dip in our return on equity from loans and stock issued to help finance our Latin America plant. However, the equity investment proved to be a successful one, as you can see. In 2012, we continued to exceed our investor expectation and continue to do so through 2020. 2015 to 2020, we purchased back stocks. We also paid dividends, causing our stock prices to increase. This led to our return on equity increasing. We did have a small dip in our return on equity in 2019 and 2020 from financing, purchasing more capacity, but we do think that the purchase of this capacity will result in increasing our return on equity in the years to come. Our annual image rating. This is somewhere where we struggled a little bit in the beginning. We were not successful in meeting our investors' expectations in year 2011, 2012, 13, and 14. Year 14 wasn't met, but as you can see from the chart, we did have a boost from the previous year by adjusting our strategy. In year 15, we were able to meet our investors' expectations. We did this by increasing our SQ rating in all of our plants. We also increased the utilization of superior materials in all of our plants. Doing these things allowed us to achieve the superior quality and increased our market share, which in turn allowed us to meet our investors' expectations on our image rating through 2020. Our annual credit rating. In 2011, it was the only year that we were not able to meet our investors' expectations. The causes of this were due to taking out a significant loan to build our Latin America plant. This increased our debt to asset ratio. We also attempted to still pay $10 million in dividends that year while using our cash on hand to finance 50% of the plant. This decision resulted in limited free cash flow, which put us at a high risk for default on our loan. Years after that, as you can see, we worked towards increasing our credit rating through increasing our net profits, lowering our operating costs, as well as strategically paying off loans and taking out loans. These proved to be successful as we were able to maintain a credit rating above investors' expectations. Lastly is stock prices. In 2011, our stock prices were directly affected by a decrease in our return on equity, our earnings per share, and our credit rating. By 2013, we were exceeding investor expectations again. From the chart, you can see there was a big jump in 2015 where we grew our market share, we achieved revenues that allowed us to repurchase stocks as well as paying dividends. We were able to continually exceed our investors' expectations from 2013 on with our stock prices. We did have a small dip in price in 2020 from using the cash on hand to purchase excess capacity, to purchase another company's capacity, rather than paying higher dividends that year. This purchase will allow us to create revenues, so going forward we can pay higher dividends going forward. And that is it for our financial overview.
Thank you, Stephanie. And before Ashlyn talks to you about what the future looks like for Best Fit Footwear, I want to talk to you about what has made us so successful from year 2010 to 2020. And in order to start that conversation, let's take a look at our strategic vision. Best Fit Footwear aims to be one of the top 5 leaders in the athletic footwear industry, leading globally in the wholesale market segment with a strong presence in the internet market segment. Best Fit Footwear is dedicated to providing superior quality, innovative designs at affordable prices while maintaining a commitment to our corporate social responsibility. Our footwear is designed for the hard-hitting athlete and the everyday user. Best fit is the best fit for you. Well, how does that translate into performance? Taking a look at our internet market strategy, Best Fit pursued a global differentiation strategy aiming to be better than industry average in all of the key areas, including an increased SQ rating. We offered more models than the competition. While lowering sell price, we utilized celebrity appeal and increasing advertising efforts. This graph is taken from our North America internet market segment, and you can see Company B there positioned nicely in the middle with a healthy share of that segment. Looking at our wholesale market strategy, we pursued a global differentiation strategy aiming to be better than the industry averages in all the key areas. In year 10, we built a plant in Latin America to increase production. We purchased more capacity in North America and Asia Pacific. We increased SQ rating in all plants, increased models offered, maintained competitive sell price in each region, utilized celebrity appeal, and increased our advertising efforts. Increased the number of retail outlets that sold our shoes. All of that equaled increasing demand for our product. And again, this is taken from our Europe Africa segment, and we see Company B, nice big orange circle there, positioned well in the middle. Our overall SQ rating and market price results, we can see the graph here. We lowered our price while increasing our SQ rating to develop a competitive advantage over our rivals throughout the industry, using cost and quality as the drivers. For our private label market strategy, it was evident to us early on in year 11 In year 12, we noticed that supply was exceeding demand, which made for an unstable market. We decided in year 13 to focus on our branded distribution, which worked out well for us. We did continue to monitor the private label market and decided to re-enter it if upon meeting two conditions. One is that demand exceeded supply, and the second being we had excess capacity to do so, not taking resources or away from our primary target, which was the wholesale market. In year 20, we were able to do that. We noticed in year 18 and 19 that demand did exceed supply in 3 of the 4 regions. So in year 20, we entered back into the private label market and was able to be one of the top 3 companies in the North American segment. So this is our graph broken down, our market shares broke down by segment and year. We see in year 10 we started off with a nice healthy 11% share of each of the 3 segments. Year 13 is where we abandoned the private label strategy and focused on branded distribution, and we see level 13 our wholesale market shares boost quite a bit there. Year 20 is where we re-entered the private label market, and we ended year 20 with nearly 15% of internet sales, over 15% of wholesale sales, and about 11% of the private label sales. To get the nice overall picture, we have a few graphs here to show you. We started year 10 with 11% market share and ended year 20 with nearly 16%. Looking at that by segment again, we see in blue our internet sales steadily increased, as well as our wholesale sales and our private label sales. That concludes our year 10 through year 20. Now Ashlyn is going to talk to you a little bit about what the future looks like for us.
Thank you, Anna. My name is Ashlyn, and I will be going over some of the production and financial strategies that we have for our company. Also be talking about some of the goals that we have lined out for years 2021 and 2022. So taking a look at our production strategies, one thing that we really tried to keep in mind was the different trade agreements between countries before we made any production decisions. Due to the free trade agreement that is currently standing between North America and Latin America, we decided it would be a good idea to open a plant for additional capacity in Latin America. We also purchased additional capacity for our North America plant and our Asia Pacific plant as well. Another thing that we did is we increased compensation and increased our training programs in order to lower our reject rates and increase employee productivity. We also upgraded all of our plants, and this helped boost our SQ rating by quite a bit for each plant. This was something we did pretty much as much as we could, and it really worked out for us in the long run. We also utilized overtime to meet forecasted demand, and that was another thing. So taking a look at our financial strategies, we took out loans and pretty much paid all of them back early in order to obtain the credit rating benefits that came along with that. We also financed our LA plant with a 50% loan, and the other half came from company cash flows that we had on hand. We also would issue additional stock and then turn around and repurchase it before it went up significantly in value. After year 14, we pretty much started repurchasing stock every year, and this really helped us get closer to our financial goals. For the first few years, we ended up paying out dividends by about a quarter each year until we got to a point to where our ending cash balance took us out of the chance for overdrafting. At that point, which it was year 18, we began increasing our dividends by $1 per year. Another thing that we did is we ended up dropping the social and corporate responsibility. We found it wasn't meeting our investor expectations, and it really didn't have the benefits we initially thought it was going to have on our image rating. For year 2020, one of our goals was kind of to increase our dividends by $4 each year. So taking a look at our competitor analysis, we looked at our internet market and found that Company F and Company A were our largest competitors. In the wholesale market, we found Company D and Company A to be our largest competitors. When we looked at the private label, this was kind of a market segment that we found that we really weren't able to be competitive in due to pricing. Later in year 2020, we ended up, we kind of started getting back into the private label, ended up getting about a 12.1% market share in the North America area and an 8.1% market share in the Europe, Africa, which definitely made us a strong competitor. Overall, we found that Company A and Company G were probably our biggest competitors throughout this whole, game series. So some of our targets and goals for year 2021 and 2022 are as followed. Equity per share, we have as a screen list. Year 2021, we want to have $9.29, and then year 2022, we want to have $10.22. Return on equity rates, we want to have 20.5% for year 2021 and 22.1%. So that's all kind of increasing each year. Credit rating, we want to stick to A+ credit ratings for each of these years. Our image rating, preferably in year 2021, will be 71, and in 2022, we want our image rating to be 72, so go up a little bit at least. Our stock prices for these 2 years, $138.77 for year 2021 and $152.65 for year 2022. So how are we going to maintain our competitive advantage? One thing that we really found beneficial was to purchase excess capacity. That was our main thing. If we continue to do that, I think we'll definitely be able to maintain this competitive edge that we seem to have over some of the other competitors. Also, if we maintain our differentiation strategy, not putting all of our eggs in one basket, but kind of spreading out, like not putting all of our attention to the private label or, one specific market, I think that really helps us and has helped us to maintain a competitor during this whole game series. Another thing was the private label. If we can get more into the private label, like I said earlier, we kind of steered away from that in the beginning stages. If we could kind of get our foot in the door on that, that would definitely kind of help us spread out across all the different market segments and really help us maintain that differentiation strategy, which will help us maintain the competitive advantage. So one of the things, like I had said earlier, our biggest lesson learned overall was that not to put all your eggs in one basket, not to focus on one market segment. We thought private label was going to be a really important segment for us to stick to. We kind of found that that wasn't necessarily the case, and we kind of focused more of our attention on wholesale and internet markets. This really seemed to help us later on. Like I said, our eventual goal would be to kind of work our way back into the private label market. And that's pretty much it. Thank you guys for watching. I hope you enjoyed the video.